I follow the resource sector, and that's been particularly hard hit in May and June. And I think, to summarise, it's really due to concerns around global economic growth. And that's been driven by a number of factors, which I think we're all aware of. Surging inflation, which is driving interest rates higher. You've also got the Ukraine-Russia conflict. And importantly for commodity markets, you've also got shutdowns in China due to COVID. So what that has meant is that commodity prices have come under pressure, and that's fed through to a deteriorating outlook for the resource stocks. I think on top of that, more locally, what you've seen is cost pressures, in particular fuel and labour. Impacting on the companies. So essentially what you've got commodity prices trending down and costs trending up, and notwithstanding the A dollar falling against the US dollar, which is a positive, it hasn't been enough to offset those negatives.
I guess first of all, we've had a significant correction in stock markets generally this calendar year, and so hence it's not really surprising that when you have a decent sell-off in equities, small caps get hit harder. I guess at the heart of the sell-off in 2022 has been investor fear that rising interest rates, rising inflation is going to lead to an economic downturn. So in event of an economic downturn or even recession, small caps being less defensive than their large cap peers typically just will underperform in that kind of environment. So I don't think it's overly surprising what we've seen to small caps. It happens every time there's a decent sell-off, and so whilst disappointing for funds focused on small and mid caps, it has provided some opportunities as well.
Primary drivers of the impact on the small and mid caps have been the same issues that have affected, broader markets locally and also internationally, and that is the impact of the current surge in inflation and the extent to which the current central bank strategies of addressing the inflation with higher interest rates are going to work, and the fears that those strategies will not work without further increases in interest rates. And then added to that, the impact of the higher interest rates and the inflation on economic growth, and of course on the all-important corporate profits, and then ultimately relatedly the impact of higher interest rates on valuations. Now those issues have affected equities and asset classes across the board, and in the case of small and mid caps, it's been complicated further by the almost complete lack of liquidity as buyers have stood on the sidelines.
Yeah, look, we think there's some opportunities starting to emerge. I think you need to be cautious on what areas you go into. And what we tend to do is focus on what we see as the key resilient investment themes, that are sustainable. And I think the big one there is decarbonisation and the energy transition. So the commodities associated with that, such as copper, lithium and nickel. And then secondly, a recognition that we're going to see increased geopolitical risk, increasing global tensions, and that's going to create opportunities from time to time. So we tend to build our portfolio around that. So particularly what we've seen in the last month or two is copper come off pretty significantly. It's now sort of testing the operating cost level of a number of producers. So we think there's some good buying in the copper space at the better quality ends. And then the other area, I think, is lithium, where notwithstanding the lithium price has actually remained pretty solid over the last couple of months. You've had a pretty major sell-off in the whole sector, but also in the better quality ones. So that's where we're looking to boost our exposure at the moment, is particularly in the copper space and lithium.
Firstly, yes, I absolutely think it's providing some opportunity. If you look back, which seems like a lifetime ago, but even to that second half of June, I think there were some very significant buying opportunities in a range of small and mid caps that we've owned and followed for a long time. In fact, even since that sort of second half of June, we've seen some significant bounces in a lot of those stocks. But and some of those stocks I'm talking about, I guess, would be Pinnacle, Dicker Data, MA Financial, AP Eagers, and a range of lifestyle communities, which have seen their stock prices absolutely annihilated in 2022 year to date. In our view, more so than is warranted. And whilst we understand there's earnings risks and valuation risks for a lot of these stocks, I just think it's been excessive. Given, I think it's important for investors to keep in mind this current period we're navigating through of high interest rates, high inflation. You have to keep in mind how long will that be in place for the next 2, 3, 4 years, which is the kind of holding period that you should be looking for when you're owning good quality businesses. So I think it's definitely provided some opportunities. Could there be more pain? I guess that's, of course, it can't be written off. To see significant downside from current levels, I think you need to see inflation globally in Australia continue to almost accelerate, or if not accelerate, stay at very high levels. And I think on balance, that's probably unlikely. I think it's more likely that those inflationary pressures, reduce somewhat over the next 12 to 24 months. We've already seen a lot of commodity prices and start to fall the last 4 to 6 weeks. Even oil's fallen a little bit from pretty high levels. Labour, particularly in Australia, the labour market's still very tight. So I think the wage pressure is probably one part that will still stay pretty strong. But look, generally speaking, I think the inflationary pressures should improve somewhat going forward, and also the aggressive hikes by the central banks around the world, that should reduce economic activity somewhat, which in turn flows through to lower inflation as well. So look, I think often with these corrections, when you're navigating through them, it feels very tough, and there's always legitimate reasons for why equities are getting sold off. But often the key point is to say to yourself, well, how long is this current environment going to remain in place? Because a lot of the time with these sell-offs, 18 months, 24 months down the track, with the benefit of hindsight, they've proven to be great buying opportunities. So that's my overriding view right now of where we're at.
Investors have to realise that cycles are an important part of investing. At various points in time, the stock market offers opportunities with very high prices based on strong optimism. At other points in time, pessimistic attitudes lead to low prices. As we navigate through these different cycles, investors that can genuinely look through the noise and look through to the next cycle can invest in businesses at in the current climate at very attractive prices, as long as those businesses have products or services and managers that are able to navigate through the current cycle and be there on the other side.